The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is senior Chanticleer columnist at the AFR, Tony Boyd. Tony, how are you this week?
Very good, James, and happy to report it's not raining in Sydney for today anyway, but another wet weekend coming up.
Fair enough. Well, this week we're going to try and make sense of what's been a crazy little period on global markets, made a little crazier by the RBA's surprise move. We're going to try and answer the question of what's happening at Credit Suisse, and we're going to look forward to the number the entire financial world will be watching next week. But first, Tony, you had a great little scoop on Thursday about a letter that the Australian superannuation regulator has sent around to some of our country's biggest super funds. Now, what's got the watchdog worried here?
Well, James, I got this phone call after I wrote a column about the opaqueness and lack of transparency in the valuation of unlisted assets around the world, especially private equity and venture capital. And the source said, hey, listen, there's been a letter sent out by APRA. It's basically saying to a number of big super funds, how did you value your stake in Canva, this incredibly successful Australian software company? And, of course, I was able to confirm that the letter had gone out. It's really part of a broader crackdown by APRA on the valuation of unlisted assets. And I think APRA is concerned that the processes aren't robust enough. And that's pretty important when you've got daily unit pricing and people can move their money around. Because if the valuations aren't accurate, then the person potentially coming in or leaving the fund is disadvantaged.
Yeah, that's right. And we should say, Tony, this isn't just about Canva, which are, it's a fabulously successful tech company, but this is about the bigger issue of how super funds have ploughed hundreds of billions of dollars into private assets. So a public asset is a share listed on the stock exchange around the world. Super funds have got lots of those, but more recently they've gone into public assets. In the last 2 decades, particularly in the last 5 years, they've really ramped this up. So this can be all sorts of things. It can be toll roads and ports and privately owned bits of infrastructure, but it also can be private equity and it can also be venture capital. And the amount of our superannuation money that's now in private equity, venture capital and other private assets is huge. So the way these things are valued really matters, doesn't it? Definitely does. And I think the concern that people who don't have a lot of these private assets in their funds is that they're being somehow disadvantaged. But let's face it, the reason that big super or industry superannuation funds in Australia have had 9% per annum annual returns for the past decade is because of their unlisted asset exposures. They were some of the first big funds in the world to get into infrastructure, possibly on the back of Macquarie Group's own sort of expansion of that. We all remember Nicholas Moore starting off the first toll road, packaged up and sold off with multiple fees across every aspect of it. And that was the beginning of this boom, which is continuing. Yeah, and as you say, the boom's really been good for Australian super funds and Australian workers who are the ultimate members. But the question is, we're now seeing in the last 9 months, so far this year, we've seen public markets fall really rapidly. So they're down somewhere between 17 to 40%, depending on which market you're in. But the private assets aren't going down as quickly. So the question is, how will these private asset valuations move? Will they move like public assets have moved, or will they move in a different way? And at the moment, it's all pretty difficult to see. It's all pretty opaque, isn't it, Tony?
It is. And when you think about technology stocks around the world, they've fallen by 50, 60, 70%. And those big revenue multiples, because that's how they were valued, they didn't have any profits to use a PE multiple. Those changes haven't happened in the private markets. And, just on Canva, for example, it's still valued at, I think, 17 times revenue, when the mean sort of average over time is about 7 or 8. Now, the articles I've written about Canva have upset the company because I wasn't invited to their big strategic day in September when they announced they were going to take on Google and Microsoft. I mean, I didn't really have an opportunity to comment on that. But that revenue multiple can't be sustained, especially if they're taking on big companies that have a combined market value of about $3 trillion US. I mean, these companies are valued at 120 times Canva. I mean, that competitive market is bound to affect their profitability as a company going forward.
Yeah, and this is not to say, Tony, that Canva's in any trouble or it's not a great company. I mean, what they've done to build this platform is phenomenal from a Sydney base. The question is just what it's worth. And as we've seen with Apple and Facebook and Google, they're all just worth less than they were this time last year. And that's the question that the super funds need to sort out.
Well, the whole question for me is, are we allowed to have smoothing of earnings? And that's really what's going on here. I remember in the 1990s when the Americans turned up at Westpac and these geniuses were very conscious of what had happened in the recession in 91. And they said, let's put dynamic provisioning in. We'll provision for every loan when we write it. And of course, this allowed the bank to smooth its earnings as the cycles turned. And the regulator at the time got quite upset about it and said, we're not having this smoothing of earnings. We want day-to-day marketing of marking to market of valuations, and you guys just write your loans. And it's interesting that smoothing of earnings is, I suppose, in some way happening in the banks today, but to a much lesser extent when they make an economic sort of provision. But I don't think smoothing of earnings is actually something that investors getting daily unit pricing should really have to put up with.
Yeah, no, I agree. This is a big issue, and I can tell you that our team Chanticleer is very much focused on this one, so we'll keep digging. Just very quickly, Tony, I'm loath to bring up football of any type, given the two football grand final tips you've given on the Chanticleer podcast have been so horrible. but a man that we used to talk to a bit, the former NAB CEO, Andrew Thorburn, he had a bit of a rough week. He lasted just one day as the chief executive of the Essendon Football Club before resigning after a furore about his connections to a religious organisation. We're not going to get into the ins and outs of that decision. But, Tony, can you think of a shorter stint in a high-profile public role over your career?
Yes, I can, James. And just before I get to that, I thought I'd go back to Fairfax itself, which is now merged with Nine and become a much bigger and better company. Fairfax had a guy called Bob Mansfield who lasted, I think, in the job from November 95 to May 96. So his is a pretty short tenure for a CEO. I mean, that's not great. But the best one of all, I think, is Mal Meninga, the former Canberra Raiders rugby league captain. He went on a Canberra radio station to announce his political career. I mean, you can watch this on YouTube. It's magnificent. The guy asks his first question and Mal goes, "Bugger it," leans back and just walks out of the studio. So I think his political career lasted for about 28 seconds. That has got to be one of the shortest in history of any person trying to achieve high office.
When you got to go, you got to go. So I guess he pulled the pin at the right time rather than trying to fake it till he made it. Well, Tony, let's get a bit serious now. Although it is harder to remember. If it wasn't so serious, it'd be funny. A crazier week on global markets than the one we've just been through. Last weekend, investors were close to despair, worrying that rapid rate rises were starting to break stuff in financial markets and there could be issues with the stability of the financial system. But then, remarkably, after some bad news about the possibility of that big parts of the world are heading into recession, we got this really impressive rally on global markets. What on earth has gone on here this week, Tony? Have you been able to handle the roller coaster?
Yeah, look, I had a check on my super fund and it hasn't come back as much as I would have liked, James. But I think what happens is the market always looks through sort of current events to the next 12 months. And when they saw the RBA back off from a 50 rate rise, which I got wrong as down to a 25, the perception was that, maybe there'll be some soft landing and maybe the conditions aren't there for a recession. So that certainly, I think, helps explain what happened in Australia, and maybe also in the United States. There's this feeling that there won't be a really deep recession, because I think you'll find that there's some positive numbers or indicators about how households are in America. But the rally didn't last all week, did it? I mean, you wrote a very good column about that one. What was your take on it?
Yeah, I mean, I think what we had at the start of the week was a fear that that central banks around the world, particularly the Federal Reserve, were going to tighten. We're going to lift rates too fast and too high, and that was starting to break things in the financial system. So the bond market crisis we had in Great Britain a couple of weeks ago, and there were signs of some stress in US credit markets as well. These were signs that the speed at which interest rates were rising was starting to bite in ways that are, really not what anybody wants to see. So then what we saw over the initial part of the week was bad news was good. We saw these weak manufacturing activity surveys come in, and that had people starting to think, well, maybe central banks are going to take their foot off the accelerator a bit, and they'll start to pivot back towards either slower rate rises or perhaps pausing rate rises altogether. And that sense was definitely was definitely underscored by the RBA, who everybody thought they were going to raise by 50 basis points or 0.5%. What they ended up doing was 25 basis points or 0.25%. And they said, we're just not sure of, we've raised rates a lot already. We're not sure of how that's going to flow through the system, and we'll take a little bit of time to work that out. There are some differences, though, Tony, between Australia and the US, aren't they? I mean, the structure of our mortgage market's probably the biggest one. We have a lot of variable rates, whereas it's very different in the US.
Yeah, that's right, James. And you may have heard about the Reserve Bank's Financial Stability Review came out on Friday. There's some very good charts in there just comparing the differences between various countries. And, of course, in America, it's 30-year fixed rate loans, which have the double advantage that when things get bad, like during the global financial crisis, you just hand back the keys. No one's going to take you to court. And that's why there was a massive losses across all banking systems for subprime mortgages. But just today in Australia, I think only 30% of home loans are fixed. But that Financial Stability Review did contain some quite concerning data that there's 1 in 5 home loan borrowers are going to pay 30% of their income on home loans. So that's the Reserve Bank. You can see why perhaps they're slowing down. They want to see the effect of their tightening cycle. And the other thing I'd just quickly mention about that Financial Stability Review report was the conditions are changing around the world. They're noting the increased risks of difficulty in financial conditions tightening and what that might mean for just the global economy and financial institutions.
Yeah, we get to the end of the week, Tony. We've seen despair at the start of the week on markets. We've seen a bit of hope earlier in the week. I think as we get to the end of the week, it feels like people are back being a bit grim. Has much changed, or is this still all about rates, interest rates, and inflation?
I think you're right. I think it's the people are trying to figure out what the ultimate end game will be. Will the terminal rate in America be 4.6%? What will it be in Australia? And then these numbers get factored into how you value the market. But when I look at the ASX today, if you strip out the financials and the listed property trusts, it's still trading on a PE of about 20. And I reckon that's pretty high. And so I think the market's not cheap. It's pretty fully valued, and so that makes it harder for people to justify paying much higher prices than where we are, and especially when you consider the earnings outlook is only for EPS growth of about 5 to 6%.
Yeah. I guess the only thing I'd say in response to that, Tony, is at least we're in Australia, we make a lot of stuff that people are going to need come hell or high water. So we export wheat, we export steel, iron ore to make steel, we export coal and gas and oil. So these things are at least essential around the world, wherever economic conditions go. So I guess that's one point in our favour down here. We could be a bit of a shelter from the storm because we produce these essential items.
And so where do you think rates are going to go from here in Australia, James?
I'm a bit more of the view that the RBA might get there a bit slower, but they're still going to go as high as the market expects, which is to take rates to 3.5% by the middle of next year. I think the economy is still running hot. We had dinner with a big bank during the week, and they say they're getting daily spending numbers, and they say no one has pulled their heads in yet, that there is no signs of spending reducing. It might have plateaued, but it is not reducing in any way. So I think the Reserve Bank's still got a fair bit of work to do to actually cool the economy. Are you more of the view, Tony, that they might take the foot off the accelerator?
Yeah, look, I think they might because if you read through the lines of that financial stability review, they're getting quite worried about what's happening in the corporate lending market. And if companies start to experience difficulty in refinancing, that's going to feed through into potentially, their employment and how many, jobs there are. I was out with the CEO for dinner this week, and we were talking about what's happening in the corporate debt market. That person's particular borrowings have doubled as they went back to renew get new maturities of debt. So that's something that's going to play into the minds of you would hope into the minds of the Reserve Bank board as they decide what to do next.
Yeah, absolutely. Tony, another thing that's going to be on the minds of central banks around the world is how much pressure is going to start to come on individual financial institutions. We saw this week with Credit Suisse, which is a big Swiss banking giant that has been under pressure for some time due to a series of scandals and losses. But all of a sudden on Twitter last weekend, there was rumours everywhere that the bank could suddenly collapse and we saw one Australian journalist from the ABC suggesting he'd been told a bank was on the brink. And that sparked a whole lot more speculation about Credit Suisse's position. Have you ever seen something like this, Tony? Is this a unique thing in the social media age that rumours and speculation can spread, from Sydney to Singapore and to Switzerland in the space of a few minutes?
Yeah, look, it's the bread and butter of social media, isn't it? You can put out whatever you like under an anonymous name. And although in this case with the Credit Suisse situation, it was a journalist at the ABC, and that got picked up elsewhere. And of course, now I even saw a story in the Wall Street Journal quoting the storm that he created. But to find a sort of comparable thing in my career, I had to go all the way back to the 1990s when the golden tonsils, John Laws, got on the radio and said that St George Bank was going to go bust, take your money out.
Right.
It was amazing. The Premier at the time, Neville Wran, had to get on the radio and say, no, we're going to stand behind St George, which is, I don't think any state government had ever done that before. Maybe you'd go back to the crises of the Bank of New South Wales in the 1830s or something.
But, you were a mere teenager back then, Tony, weren't you?
Yes. Well, of course we know the Bank of New South Wales now is Westpac. But look, it's one of those stories that has had real implications, though. The share price of Credit Suisse did fall sharply. People started to believe this stuff. It's since bounced back, and I think you had quite a good. I think you called it Credit Suisse sources. I won't ask who you spoke to, but it sounds like the bank is trying to sort of calm the waters out there.
Yeah, I mean, I think the bank spent the week trying to calm the waters, and there were a lot of waters to calm. But I mean, essentially their argument is they've got no issue with capital. They've got basically $150 billion worth of capital that they'd have to burn through before the bank was in any serious issues. They've got no issues with their liquidity coverage ratios as high as any other bank in the world, actually a bit higher. So, but what they've really got is sort of an old-fashioned problem. They've got not enough revenue and too big a cost base. So they are in the middle of this restructuring process. And they've probably done that a bit foolishly. They've said, give us 100 days and we'll come back and tell you how we're going to restructure the bank. What happens then? People spend the next 99 days guessing and speculating about how that restructuring is going to work. And you get this sort of pile-on of this febrile atmosphere of rumour mongering and speculation, and that's where we end up. But Tony, you wrote about investment banking this week. Obviously, Credit Suisse has got a big investment bank, particularly in the US. It's a pretty grim time to be an investment banker. That they had the greatest run ever during the pandemic, and all of a sudden the taps have been turned off.
Yeah, the Deal Logic investment league tables, which cause enormous amount of controversy because every banker has a way of cutting them to make themselves look better than they might actually be. But the point about them, from my perspective, and directly to what's happening with Credit Suisse was Credit Suisse is nowhere in the global M&A top 10. You'll find them number 7 in syndicated loans and number 7 in high yield leverage finance in America. But these are very specialised areas. And to be honest, the overall message out of the Deal Logic information is that investment banking is going through a pretty hard time at the moment. It was a brilliant year, 2021, but now basically M&A volumes have plunged. There is no IPO market, so the ECM revenues are down, and so there's a lot of mouths to feed and not enough activity. So that'll probably have implications. The collapse the blowout in yields in leverage finance is probably going to lead to losses as US Wall Street investment banks report their latest quarters. That could have implications for jobs. Compensation bonuses tend to sort of get looked at in December for the Americans, and they pay them in January. That could be tough. But as a sort of in total, there's probably a bit of a cold winter, let's say, in the investment banking world.
Yeah, which makes it, coming back to Credit Suisse, it makes it a really tough time to be doing this big restructure. Not only do you have these questions about Credit Suisse's own plans, but you've got this environment that's very volatile and very difficult for investment banking. Tony, thinking about Credit Suisse's restructure, can they stay in investment banking, do you think?
I reckon they've got to bite the bullet and get out of it. I don't think the capital light model of Credit Suisse First Boston, which harks back to where they first started, is really worthwhile. They should just stick with wealth management and asset management. They've got 800 billion Swiss francs under management. It's a world's second largest wealth manager. It's capital light and it's got strong margins. I mean, just go back to that, plus that little private sort of Swiss bank in Switzerland, which I'm sure has many loyal customers. And just admit that this exercise in trying to build a world-class global investment bank has failed. I mean, what do you reckon? Are you a fan?
I was going to say that maybe they can try and stick it out. The one thing is, in the US, most of their business is around investment banking. So if they want to stay in the US, do they have to keep the investment bank? But that would be my response. But I think you might have convinced me, Tony. I think the simpler is better model is probably the way to go, particularly when you're under severe financial pressure. But one thing, we'll get a look at the investment banks in the US late next week, when they start to report. So perhaps that'll give us a better sense of where they're at and where Credit Suisse might be at. Tony, we'll come back after the break. There's another big number in the US that we're all waiting for, and we'll have a look at what that's going to be. Okay, Tony, it's the number that everyone in the world is going to be watching, and that's US inflation. Comes out next Thursday morning, Australian time. Last month, unfortunately, US inflation jumped back up, but hopefully The betting is that we see a slight easing, headline inflation hopefully falling from 8.3% in the US, which is still very high, back to 8.1%. I mean, could this be the thing, Tony, that gets markets going again if inflation came in lower than expected?
Actually, I'm not sure it will, James. I reckon this latest development with OPEC and the fight between the Americans and the Saudis over the Middle East basically supporting Putin in Russia, I mean, this is a combination of factors that's going to lead to higher energy prices and potentially, I mean, one of the biggest factors in people's, I suppose, consumer confidence growing in America was lower gasoline prices. I think they dropped by about $1 a gallon, which is a big change. The point being is that if this deal with OPEC restricting production leads to a rise in energy prices again, then people will look past this inflation number, even if it's a good one, and think, yeah, this is not good.
Yeah. I'm a bit on the other side. I reckon if we had a weaker number, we could really see the markets rally. I think what we've seen this week is people want shares to go up. They're barracking for the rally, and if there's just any hint that the Fed might take the foot off the accelerator, that could be good for markets, given how low sentiment is. Couple of other things to look for, Tony. Commonwealth Bank has its annual general meeting down in Melbourne at the mighty MCG. What are you expecting here? What are the main questions going to be for the new chairman, Paul O'Malley, and chief executive, Matt Comyn?
Well, every year the environmental activists stick two resolutions on the agenda, which one of them asks for changes in the Constitution and the other asks for the company to end its financing of any new or expanded fossil fuel projects. So they're back on the agenda. The company itself, the bank, has said to shareholders reject both those measures. So there'll be a lot of discussion about that, I'm sure. The Commonwealth Bank just recently announced its sort of sustainability policies, and they're really trying to build a whole image there as one of the sort of cleanest and greenest and most involved institution in Australia's energy transition. So they've got a lot of positive things to talk about. It's just a question of whether or not, I suppose, let's watch and see what the big institutional shareholders do. If they really back these resolutions, the board might find that it's out of touch.
Yeah, maybe. I wonder if we'll see any questions about housing stability and where the market is. It's you're right, these AGMs tend to get taken over by environmental issues in recent years, but maybe we'll see a few people worried about how the banks are going to hold up as interest rates keep rising. One other thing to mention, Tony, is the AFR has its Energy Summit in Sydney on Monday and Tuesday. Full coverage all over the website and in the paper. But one thing I wanted to pull out, we've been talking a lot about this, is AGL. AGL's chairman, Patricia McKenzie, will be interviewed on stage. What are you expecting to hear from her?
Well, look, I think she'll be doing a refrain of the types of interviews she did when they announced their the results of their strategic review. I'll be interested to know if she's going to back the new 4 independent directors that have been put forward by Grok Ventures, which is Michael Cannon-Brooks. And by the way, MCB and his team have pushed back very hard against what I said on the podcast before, that yes. What is happening here is a takeover of control of the company without paying a premium. Now, I know that these 4 people are fiercely independent, but I think we have to face the fact that they are nominated by him. If it all goes ahead, they will have essentially a majority on the board, and like-minded people voting in a like-minded way could end up doing things that are not necessarily what those existing incumbent directors want.
Yeah. No, I think they were. I think you're right. You know, they're nominated by Grok, and while they're individually they'll be independent, no doubt. That they are coming from that same team. So, while we wait for Patricia McKenzie to be questioned last week, we've got to say a big thanks to all our readers who've sent in questions. We've got some lovely feedback and some really tricky conundrums for the chooks to solve. including this one from Chris Wallace, who asked us about the rising influence of ETFs, which are exchange-traded funds. They're a low-cost way for retail investors and others to invest in the share market. And Chris asks, ETFs are mainly buying very concentrated stocks, something like every $1 that goes into a US ETF, 30 or 40 cents of that goes into only a handful of stocks, such as Apple, Amazon, Tesla, etc. And Chris says, I think something like 350 ETFs hold Apple stock at the moment. So if the tide turned on financial markets in a serious way and ETFs start experiencing significant withdrawals, will this amplify the losses for the entire market? And could it negatively influence the prices of those stocks in which ETFs hold a concentrated position? Well, I've done a little bit of research here, and looking at what Vanguard and BlackRock hold, the two of them combined are in the top 3 shareholders of 99% of US listed companies, which just goes to show their influence. What do you think, Tony? That this has always been a concern that the big flow of money into ETFs could amplify share price movements. Is it possible?
Look, I don't think so, James. Personally, I think exchange-traded funds are one of the greatest inventions of the past 30 years. Prior to that, the greatest invention as a financial product was managed funds. And the beauty of ETFs is, what else can you buy at a basis points of like 20 cents in the dollar to get a managed asset? I mean, I think I'm paying my financial plan at 1%. That's 5 times more. And here you can get exposure of diversity across many different stocks. And I take the point that there is a concentration in certain big tech companies in America. But when you look at it, go back through COVID, the Ukraine war, the reset recently of technology stocks, I don't think that ETFs through that period exacerbated whatever problems we had. I think the biggest problems were the volume of turnover of shares on stock exchanges like the ASX. They had to take a whole weekend in March 2020 to clear all the trades. So, yeah, I think they've been through testing times and come through as good, reliable, low-cost ways of investing in a diversification of companies.
Yeah, fair enough. Well said, Tony. Keep the questions coming. Chanticleer at afr.com is the email address. We're thrilled to hear from you and look forward to getting plenty more questions. Well, Tony, it's been another massive week. We keep saying this, but geez, the news flow is incredible at the moment. Thanks so much for joining us again today.
And thank you, and thanks for not asking me to tip a football team again.
I'm waiting for the Melbourne Cup. I'm sure everyone's waiting for your top tip there so they can put a line through it.
Thank you, James.
If you like the podcast and want to hear more, consider rating and reviewing us as it helps others find us. And follow us on Apple or Spotify or wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Tony Boyd, and it was produced and edited by Lapfan.
The Australian Financial Review.